Good morning, everyone. Welcome to today's Regional Economic Conditions webinar on construction conditions. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Fed. We're glad that you're here with us today. Before I turn it over to our speaker, I want to let you know that we will be emailing slides and video of this presentation to all registered attendees at some point next week. At the end of Ron's presentation, he will be taking questions. We'll be fielding those via the chat box on Zoom. So if you have questions at any point during the presentation, you can type those in the chat box on Zoom. And as you close out of the presentation at the end, you'll receive a little pop-up survey, just a quick few questions asking you what you thought of this webinar. We'd appreciate if you would fill that out. And with that, I will turn it over to Ron Wirtz.
Thanks, Carmi. Good morning, everyone attending today. Thanks for taking the time today on a Friday to share in the results of a recent survey that we did with construction firms. I have a lot of content to share. Some of it I'm going to go actually over fairly quickly, but the idea is, as Carmi mentioned, we're going to share the slide and this live feed with you. So I'm actually putting a little bit of additional content that I won't spend a lot of time on, but you'll have a chance to take a look at it a little bit more depth on your own time. So let me get started first. I have to give you my disclaimer that the views expressed here are mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So before I get into the survey results, for those that aren't familiar with this particular survey, I do it through a bunch of partners, a bunch of construction trade associations, and I just want to give them a big shout out. There are actually more than 50 across the 9th district, includes every district state, and they help me get this survey out to member construction firms. Without them, this wouldn't be possible. We learn an awful lot about it. The whole idea is to also return that intelligence to them, so I'm hoping that they find it equally useful as well. I'm always looking for more partners. So if anyone happens to be new to this particular survey and would like to get your members or other peer organizations involved, I would love to hear from you. You can drop me a note in the chat box, or my contact information will be at the end. I also just want to make everyone aware that this particular survey is part of a much larger suite of surveys that we've been doing. A number of them actually have come out as a result of the pandemic. We realized that we really needed to do a lot more grassroots kind of information gathering from businesses. You've responded wonderfully in terms of giving us lots of input on a very regular basis. Just a list here to kind of give you an idea. If you're interested in other areas of the economy, you want to learn more about it, we probably have a survey on it, and we do a lot of these webinars. Just wanted to let you know. You're here, though, I assume, because you want to hear about the construction survey. So we did this survey. This is a quarterly survey, and we did it. It actually closed just last week. So we really wanted to turn around results. So as we learn, that you learn as well. So it was conducted in mid-May. We had 405 responses from Minnesota, the Dakotas, Montana, and then we think most of our responses in Wisconsin are from the western area, which is part of our district, and then Michigan's Upper Peninsula. These results, I have to emphasize, are a snapshot only. This is not a scientifically sampled survey. It's closer to a convenience sample. And because partners kind of come and go, and I'm adding more every time I do this survey, it's not always the same exact sample. So again, it's not scientifically sampled. We do have good responses from Minnesota, North Dakota, and Wisconsin. We got a little bit more sparse response in Montana and South Dakota and the UP. So I won't be offering a lot of state-by-state results, only 1 or 2 slides actually. I also wanted to note that we're a little overrepresented in terms of our sample among firms that are working in the housing sector. So we have good results regarding the housing sector, a little underrepresented in industrial and infrastructure. Not terrible, but again, as you think about some of the results that I'm going to offer today, please interpret those results real carefully, and I will try to do the same. So first, before I get into the May survey, I want to do a real quick review of where we are from February. So real briefly, in our February survey, we know that winter activity in construction is normally a little bit slower, but activity in terms of what firms told us then is that it seemed to be a little bit slower than normal. Rising input costs were really starting to become a major concern for a lot of firms. But what we saw is, I think, some indicators that things were going to start picking up. We saw that requests for proposals, while they were still net positive, they turned net positive for the first time since the start of the pandemic. We were still seeing cancellation and delays. They were still net negative. So we saw more that we're seeing more cancellations and delays than were increasing. But they overall were declining. And we were also still seeing that hiring was continuing despite the fact that we were seeing some revenue slow down. And overall, we saw a generally positive outlook for the spring and summer. So again, the request for proposals, because that turned net positive, we really felt like we were heading into a period of growth. So now fast forward to the May survey, and what did they tell us this time around? What we heard is that overall demand is healthy, especially for housing. Then there's a really big but. We are seeing that the pipeline is growing, but it's growing more for the private projects than, excuse me, that's supposed to say for public projects, excuse me. So more for private than for public projects. We are also seeing cancellations and delays affecting more private projects than public projects. Then the really big buts are the major challenges. We're hearing about a lot of rising prices for materials. That's continuing and accelerating. We're hearing about supply chain problems and workforce availability problems. Especially when it comes to the prices, that really was the major theme that came out of this. And we're hearing that rising input costs really are dampening demand. They're also inducing more delays than we had been seeing previously, and they're cutting into firm profits. Overall, though, it feels like the outlook is optimistic still for firms, but I think they're a little bit nervous about the challenges that are lingering, and if those happen to linger, whether or not that's going to affect the market more long term. Okay, so let's get into the charts. So I'm going to throw a lot of charts at everyone, and I'll explain a little bit in terms of how these are set up, so you have a better understanding of how to read them when they come across. So a couple of things first. So the first question we ask is recent sales, and we want them to think about the last 3 months compared to 3 different periods. We want them to think about the same period a year ago, that's the top bar, then the previous quarter, and then we want them to look ahead and tell us about expectations for the summer season compared with last year. Basically, we ask them about 6 months, so that's generally the summer season plus. And in terms of reading the charts, most of these will be kind of in this red and green scale. Red means bad, deep red means worse, green means good, deep red means better. Okay, so as you look at this chart, generally what we're seeing is that recent revenue trends for construction firms are generally net positive. Not that everyone is seeing revenue growth, but a larger share are seeing revenue growth both over the same period a year ago and the previous quarter. And generally speaking, we're also seeing expectations for the summer also improved over last year. And maybe more than anything is that this is a notable improvement over sentiment in February. So let's unpack this a little bit. Anytime you do a survey, kind of the broad results they can present a fairly uniform picture. When you look a little bit underneath the surface, you'll get a little bit more granular detail. So I'm going to break this down just a little bit. So here I'm asking about revenue over the last 3 months compared to the same period a year ago. But here I want to talk about the individual subsectors: residential, commercial, infrastructure, and industrial. And here, similar to in the February survey, the residential sector really does remain the leader among these subgroups. It also is a factor in the overall results. Remember, we had an oversample of housing firms in this survey. So the fact that overall results are a little bit more positive, kind of driven by the fact that we had a lot of home builders respond to this survey. But in general, the year-over-year revenue in the other sectors, while they're neutral or negative in terms of sentiment, this also is an improvement over February results. Looking forward, revenue expectation for the next 6 months compared to last year, you actually see improvement kind of across the board. Infrastructure and heavy is still net negative, but it's an improvement. And generally, you're seeing a little bit of a compression among the different sectors to be a little bit more similar. Residential still being the most net positive. As I mentioned, I'm not going to offer a lot of state-by-state results, but I did want to give you one. So in terms of thinking about revenue expectations for the coming 6 months compared to last year, again, you're seeing mostly similar results. You have Montana up there on the top. What I do want to caution, though, is that Montana only had 22 responses. South Dakota and the UP had less than 10 responses, so I didn't include them here. Wisconsin's kind of there in the middle. We had very high responses amongst small home builders there. And I guess really the piece to maybe take away here is that Minneapolis-St. Paul had the largest response. It also had the most balanced response in terms of the different sectors. And as you see there, we're seeing a real net positive overall revenue trend for Minneapolis-St. Paul in terms of the expectations. That was one of the areas that also saw some of the biggest decline, in part because the commercial sector really kind of took a hit during the pandemic. So I would say that's a pretty positive overall sentiment for the Minneapolis-St. Paul contractors. The other thing I wanted to show, and this is the first time that I've done this for this particular survey, we asked about revenue for firms. So we get a little bit better idea on how firms of different size were performing. And unlike businesses overall, firm size is not a great predictor of revenue trends. Why is that important? When we do our other surveys, we do a general business survey, and it is a very, very clear relationship from size to performance. Basically, the bigger you are, the more likely you were to see positive or at least less negative revenue trends. Here in construction, that's not been the case. As you can see here with this chart, for the most part, firms are performing fairly similarly regardless of how big you are. Even more so, looking ahead over the summer season, it's almost identical. You know, if you were only to have just one red color, it would, and only one green color, these would be almost exactly matching. So in general, I think we're seeing very little difference in firm size, which I think is a positive trait. You're seeing more small firms be able to compete with large firms, at least in terms of their own revenue trends. So let's talk about project cancellations and delays just for a second. So especially early in the pandemic, there were lots and lots of delays and cancellations. I think just the volatility of the pandemic had a lot of people uncertain. We were starting to see those really kind of take a stair step down with each individual survey. I would say we saw a little bit of a bounce, especially in terms of private projects, a bounce back to a little bit higher. We saw a little bit higher level of cancellations in private projects, and a definitely higher level of delays in private projects. In terms of public projects, I would say the good news here is that we're seeing lower levels of cancellations. Delays actually increased a little bit. I think for the most part, we're seeing less volatility in public projects, probably because they tend to be of a larger scale, and they also have a financing mechanism underneath that is a little bit more stable and probably less prone to change. I'm sure there are people that are listening that are maybe have a different experience with an individual public project, but overall, we're seeing that public projects in general are seeing a little less volatility than private projects. Excuse me. In terms of projects, I think this also maybe helped clear up maybe what's going on a little bit, is that in terms of private project cancellations compared to February levels, we're seeing many more cancellations or higher propensity for cancellations in the residential sector. I think that's, if you think about it, it's probably not real surprising. I think consumers, households are probably a little bit less tolerant of delays and cost increases. Those are things that I'm going to be talking about, especially the cost increase here in a little bit. And I think some of that volatility is likely to get homeowners building a new house probably a little bit more reluctant or a little bit more willing to put a project on hold rather than just move forward. In terms of the future pipeline of work, it's something that we're very interested in. Again, investment in the economy, in construction, I think is a really good leading indicator. It's why we ask. And what we see in terms of requests for proposals or those new projects that are out for bid is that RFP levels are net positive for private projects. That I think that's a really good sign, despite the fact that there's some noise with regards to cancellations and delays. I would say the pipeline for new projects appears to be slowing a little bit more. That's a lot more, that's actually a little bit net negative. I wouldn't say dramatically so. But again, there's just as many that are seeing some growth as that are seeing some decline. So there's a little bit more neutral stance in terms of public projects, a little bit more positive sentiment in terms of private projects. Breaking it down a little bit by sector again, we're seeing that in terms of private projects, every sector, commercial, residential, and industrial, they're all seeing some net growth in terms of RFP levels. Infrastructure and heavy is the only sector that is seeing still a net negative pipeline in terms of more seeing the pipeline decline versus those that are seeing some increase. In terms of public projects, again, I would say it's a little bit more neutral kind of across the board. Infrastructure here is also less optimistic. So is this half full or half empty? You know, the thing that I'm really struck by, especially the one thing that respondents do really well, is they give us a lot of comments. And reading through those, you know, you really get the sense that there is fairly strong growth out there. And the problem, though, is that there are a lot of challenges out there. Firms are really faced with, I think, a growing measure of three basic but big challenges. Labor availability has been a problem even before the pandemic. I think the people that are on the call today certainly know that. Material cost increases, that's a growing concern for sure, and supply chain problems have really come up since the start of the pandemic. So among all of the factors that we gave them, obviously, as this chart shows, three jump out at us, and I will talk about labor availability and material costs just a little bit more. First, in terms of thinking about this labor force issue, the good news is that firms are trying to hire. There really is strong hiring activity in terms of those firms that are hoping or planning to add staff. And they are expecting to basically hold that over the summer. So we're seeing strong workforce demand, and that's the good news. The less good news, labor availability is not responding very well. So again, going back from our February to our May survey, the share of firms that said labor availability was very tight almost doubled. And the share that said it was moderately tight also increased a little bit. So firms are telling us very, very loudly that labor availability is tight and getting tighter. Wages are responding too. That's what we would expect. As labor gets tighter, we would expect firms to start increasing wages more. Wages have been growing. Again, we do a lot of survey work, and wages are growing in construction more than virtually all other sectors. Manufacturing can sometimes be in that conversation, but generally speaking, construction we've seen more wage growth there than virtually anywhere else. Half of firms right now, at least in this survey, say that wages have grown more than 3% for skilled trades over the last year. And that's actually very consistent across firm size, with the exception of the very smallest firms who may not have more than 1 or 2 or 3 people. We're seeing very consistent wage growth among firms that are among all firms except for those very smallest ones. There has been also where we're expecting slightly greater wage pressure over the next 12 months. And it's not just for skilled trades either. All of the other jobs that construction firms have, we kind of put them in a different basket, but they're also seeing fairly strong wage growth. Since the start of the pandemic, roughly 40% are saying that they've raised wages for all other jobs, all non-skilled labor jobs by more than 3% as well. So then the last area that I'm going to cover is material costs, and this is a big one. I think for those that are paying attention to the news, those that are out on job sites and doing the construction work, you're very familiar with the fact that prices have been increasing dramatically. So in terms of vendor prices, what firms said is 70% of firms responding said they saw price increases overall from vendors that were at 10% higher or more, and often much more. We were hearing in our comment section, we were hearing about all different kinds of products seeing dramatic increases, very often more than 10%. Steel numbers seeing the biggest increases, but it really is across the board. The other thing that I want to mention real quickly is, typically we see firms eating some of that margin, not feeling like they can pass those costs on to final customers. That has not been the case of late. Now there is a little bit that firms are eating, but if you look at the transition, the lower bar is vendors, the upper bar is the final prices to customers, and you see that there's a lot of translation up, that a lot of those increased costs are getting passed on to customers. This is one of those that I'm not going to speak a lot about. This is one that I wanted to include in that you get in your packet after this. Basically, we asked about it, all sorts of different products and what price increases they were seeing. Basically, this is just to show you that this really is a price increase seen across all kinds of different materials. What effect is that having? Well, as you might expect, steeply rising prices, they are going, as we would expect, it's dampening demand, it's increasing delays, and that kind of goes into that supply chain issue, and it's also hurting profits, firm profits, as you'd expect. If you're not able to pass on all those rising costs, you're going to take some hit on your profits. So in general, just to wrap up real quick here, generally speaking, more firms are seeing revenue increases than decrease. The overall trend from a demand standpoint appears definitely to be up, and that's the great news. Pipeline of new private projects also seeing growth. Public projects, appear to be a little bit more neutral at this point. I would kind of expect, if there is ever going to be an infrastructure bill, I would expect that sentiment to maybe change. But again, until that's passed, all we can do is report on what firms are saying. And in the public space, looks like maybe there's not as much growth expected. Costs have obviously been increasing significantly. And again, it's been dampening demand and hurting profits. That's not good for the sector. There is demand. We're hoping that if some of these things get cleaned up and, and the overall things start to be more profitable for firms. They're also hiring, but the perceived labor availability is really fallen dramatically. So firms out there really see a very, very tight labor market. The challenges, all of these challenges is that we're seeing more cancellations for private projects. Delays are also more widespread. So that despite the fact that we have pretty strong demand, that doesn't mean everybody's experiencing that in the same way. And I think, kind of the last point is that I think there's a lot of optimism. And if prices and the supply chain issues, if those happen to be transitory, and we hope so, we think the sector is going to be in a good place for more growth going forward and over the summer. Just like we went from February to May for a survey, of course, there's going to be another one for our quarterly survey. And the next one's going to be in mid-July. And if there happens to be anybody that would like to find ways to get to new firms that you happen to be familiar with, I would really appreciate it. Again, I'll have some contact info at the end, and you could put something in the chat box that can get passed along to me. Other resources, real quick, the Minneapolis Fed, our website it has a whole host of additional kinds of information. If you're interested in tracking the economy in a broader sense, we have a COVID-19 dashboard. Here you have online job postings. There's a whole host of other indicators that you can see that are updated on a regular basis, many of them real time. This one going actually all the way through late May. So you really you can get a better idea of what's happening in the labor market. We also have this recession in perspective, the chart on the right, which really is, I think, a useful tool to see where we are in this recession compared to other recessions. There are a number of different indicators that you can kind of switch in back and forth in. You can look at construction, you can look at manufacturing or total non-farm, as I have here, and just see where different parts of the economy are performing in relation to other ones. That's it for the formal part of my presentation. I appreciate everyone's attention. I would be happy to take a few questions, Carmi, if any of it have come into the chat box.
Yeah, go ahead and type any questions that you have into the chat box. Let's start with the fact, Ron, that the BLS jobs report for May came out this morning, indicated hiring was down in the construction sector. Could you talk a little bit more about that?
Sure. So let me stop here. I'm going to stop that share quick. So yes, and I haven't had a great chance to look deeply into the numbers. Construction, if I saw it right, lost about 20,000 jobs nationwide. I would call that mostly flat, which is a surprise though. I don't think there's any question. You know, you're moving into the busy season for summer, and so I'm hoping to get a little bit more granular insight or time to read, so I can understand it a little bit more. But I think it kind of fits the narrative that I just talked about, in the sense that firms are out there hiring. The fact that labor was flat in construction, to me, doesn't say that demand is down. It suggests to me probably more that firms weren't able to hire the labor that they wanted. So again, I'm kind of waiting to also see what Minnesota data is like. So I think there's going to be some different fluctuations nationwide, because markets are always a little bit hotter than others in some places. But I'm very interested to see the state level data to see whether or not that computes out. But from a national standpoint, I don't think there's any question that labor's tight. So that would probably be the strongest takeaway that I have for that particular number.
And can you elaborate a little bit on that labor tightness? We had a couple of questions in the chat saying, what do we think that's attributable to? Unemployment benefits, lack of skilled labor, childcare, where is that?
All of the above. I don't think there's any question that there are a multitude of factors in play, some larger than others. I think the useful thing, I think a lot of firms really believe that enhanced unemployment benefits are really detracting from labor availability. I think the useful thing is that we have a very natural experiment kind of unfolding in front of our eyes. You have North Dakota, South Dakota, Montana, all pulling out of enhanced benefits, Minnesota, Wisconsin staying in. We're going to get a lot more insight to that question over the next couple of months. I think it is having a role. How big of a role, I'm uncertain about. I think the skill mismatch is very clearly a problem. In terms of, there are a lot of people that are not working. We're still down, I believe, about 8 million jobs across the US. The problem is, if you happen to have been in the hospitality industry, your transition to a different career, like in construction, is not very seamless. It can be very tough to make those kind of leaps into a very different occupation. I think that was a problem before the pandemic. I think it's going to be a problem after the pandemic. That's going to be a long-term kind of problem that the industry is going to, I think, is trying to cope with. And the faster we are able to figure out how to transition people into these better paying jobs, I think is going to benefit everyone, but it's going to be a difficult one, I think, for sure.
Thank you. Changing gears a little bit, what do you think about the nature of the price hikes that you were talking about? Are they long-term or maybe more transitory?
Well, you know, we think these are more transitory. We haven't seen spikes like this, especially kind of broad-based, quite like this for some time. We do think, you know, the nature of price hikes, markets are really good about working out price hikes. Supply tends to be able to respond. We think the supply chain problems that are also contributing to this are likely to get fixed, especially as we get the virus more under control. You have fewer, you know, let's say fewer material delivery drivers on quarantine. So we think those things are going to rectify themselves over time. Problem is, we don't know how quickly. So if you know, markets left to their own devices, we think these are transitory, they'll get fixed. The part of the problem though is, you know, when it comes to things like lumber, you can't very quickly build a new sawmill. So the supply that you have is likely the supply that you're going to have going forward. So if demand continues to be really strong, well, first, that's a good thing. We don't necessarily want demand to go down just to bring prices down, but we hope that there's a little moderation. Hopefully these supply chains get fixed so product that is out there can get to where it needs to go, and that suppliers can find ways to increase the production as able, but not increase it so much that we end up seeing a huge increase in supply, you know, only to then, you know, see some crashes as well. So I don't think there's any question heading into the busiest season, you know, for the upper Midwest. I think there's some concern about how high prices are and whether or not those will stick. Lumber prices have actually been coming down from their peaks, so we are starting to see some more regulation on prices, but they have a long way to go to be back to what we would consider normal.
Great. And last question for today, a little bit of a question about our survey methodology. We have someone who is loving our quantitative data, but wondering what kind of qualitative data we get, kind of the comments, the insights, what we learned there, and do we release any of that for folks to look at?
I do actually give all the comments back to my partners. They're anonymized, so we ask respondents to, first, great question, and I'm glad you're interested in that. We are interested in that. We have done some text analysis. We haven't done that for this particular survey right now. And I should mention, we got 400 responses, but on individual questions, we might get 100 to 200 comments from firms, some in quite detail, maybe others less so. And I do give partners all of the data back, not only the quantitative, but the qualitative. So they get all of the comments, and I give them also a splice of some of it, like by firm size as well as geography. So if you are in Greater Minnesota, you're one of my partners in Greater Minnesota, you get the comments on different questions from those from Greater Minnesota. So you have a better idea of maybe how companies in your area are commenting on particular areas. We don't do as much with the qualitative information as I hope to. That's something we're working on. We read all the comments. What we do in terms of text analysis is probably something we're trying to develop a little bit more going forward.
Thanks, Ron, and thanks everyone for joining us today. We appreciate you being here. We are going to follow up next week with an email that contains a link to the video of this presentation, as well as a copy of Ron's slides. And as you're exiting the Zoom, we would love it if you would fill out the brief 3-question survey for your feedback on this event. Thanks so much, and we'll be in touch for our next Regional Economic Conditions webinar, which will be on conditions in the professional services sector. Look for that coming up in July. Thanks. Have a great day.